Hello and welcome back. If this is your first time here, I am Dr. Stock, Doctor of Education, and in this video, I want to take a look at what we got today with jobs data and then also what to expect in the week coming up ahead as far as economic reporting goes. I want to take a quick look at the markets, and I also want to talk about economic outlook, because I think there's an important conversation to be had there based on the research that I was doing today, including my CPI research that I'm going to have posted over at the Patreon. You can find the link for that down in the description. Now, normally I'd have a joke here at this point right before the intro, but let me just tell you the part that you can go ahead and laugh at. My cat somehow got a hold of a brown crayon and we'll say he colored on the office floor. So that was also part of how I spent my afternoon. So with that said, let's move on. All right, this video is jam-packed with a lot of information, so I want to get right to it. So here's trading economics. Like I said, no real stake in the company, just like the way that it's presented to everyone. I can share it nice and easy for us. So unemployment rate, we actually got this tighter than what it was. So we were at 3.6 down to 3.5 for unemployment rate. And the one thing that I have a little bit of trouble with stuff like this, when you look at just unemployment rate, is that it's a one-off number. It doesn't tell you why that unemployment rate is so low. Basically, anybody who wants a job can go out and get a job. And, well, I mean, we can just go and take a look at the chart real quick, and you can see the sort of decline we've been on here. So let's go out 10 years, and you can see that it comes and it goes in waves. So 2000 coming off the dot-com bubble, and then we have the Great Recession there. And we're a little bit jaggedy, but we're still pretty much at all-time lows, at least in the last 25 years here. So that's the unemployment rate. There we go. Non-farm payrolls, 187,000. And then we can also go to non-farm payrolls private, and that's 172,000. And those numbers by themselves aren't all that significant. Here, let me show you the charts on these. And this ties along with what the Fed has been saying about wanting to see some softening in the labor market. We actually do not necessarily, there's fewer jobs added would be a good way to put it. So you can see what happened with the pandemic, with all the jobs lost, all the jobs added, and then adding over time. And that deep gouge that we took out of that, a lot of that we find through here throughout. So if I go a little bit shorter on time, actually what's even nicer, if I go with the columns, you can see that, I mean, not necessarily that labor conditions are loosening, but they are moderating. And I think that that's really good progress in order to see that. And I think that's going to be really encouraging for the Fed. Now, when we go to private, I don't believe that it changes that much. So that's also worth looking at. You can see over just the 1 year span, if we got to 10 years, 25 years, like I said, put on the column chart, and you can see what we had over the past 25 years. And you can definitely see what the recession looked like, going all the way back to 2000 with the dot-com bubble, and then up here around 2008. Following Great Recession, again, pandemic, and then making up for a lot of that since the pandemic and that mad rush for workers. So in the employment parts of this, and then earnings, average hourly earnings, this is also worth looking at, because that is also something that if we look at it, it is something that it doesn't have as much waviness to it. There's not as much up and down, where we have some months where there really wasn't a lot of increase, and then other months where there was a lot of increases, just sort of been steady. So if we go down here, we get consumer credit change. And then if we go to Tuesday, this is the one that I'm really after, is total household debt. And from this is really what gets me going again when we look at this. So when you click on this, you can see that it says, where's the part that I'm looking for here about credit? They basically say that credit card debt has gone unchanged since the previous report. As a matter of fact, I think I can show that down here. There we go. Balance on credit cards. You can see it's even. And we might be like, well, that's not so bad. The credit card debt did not go up. Well, that's because over 20 years' time, the last time that it didn't change, or I should say the only time, I believe, I'm going to have to go back and take a look at that. But this year, 2023, Q1 was the first time that we had no change from December to January with paying down that credit card debt. Every other year we saw a dip. This year we did not see that dip, and I think that's significant, because I think we're going to get a very similar story in 2024. So I'm really watching for that, and that comes out on Tuesday, and I think that can be really impactful to us and impactful to markets. And even if it's not immediately impactful, that it gives pressure up or down on the markets, depending on what comes out with it, I think that it will tell a story, and over time we're going to see how it plays out, that we're looking for what sort of trajectory we're on, especially as consumers. And then Thursday CPI, and like I said, I'm cooking up my research for that. It'll be available over at the Patreon. You can check out that research over there. That link is down in the description should you want to go and check that out, along with my other Patreon exclusives that are out there. So I'll give commentary later on that it won't fit within this video. That has to be its own very separate video, but I will give that commentary about what I'm forecasting for that and how it matches up with consensus and the forecast that's here, really focusing on core inflation. So let's move on from there, because Friday then we get PPI, which was really good the previous time, coming in under 2% annualized inflation. And that's absolutely wonderful to see. And that can be a leading indicator of what's to come, which means that we could see good things for July's report that comes out August the 10th. So you can see that that's right here, August the 10th, Thursday is where we get all that CPI. And then not to mention we get initial jobless claims. So that leads me into the next part of my discussion here. So I've spent a lot of time looking through these different reports and having a lot of considerations. And from going all the way back to January, I was talking on my channel about some sort of possible recession and, could we see it? Could we not see it? I thought Q1, Q2, then I thought Q2 to Q3, and then Q3 to Q4, and it just keeps on getting pushed back and back and back. And, I was thinking more about that, so what is it that has forestalled it so long and kept the consumer strong? And I think that there's a really nice way to look at this. Let me put this up here for you. This is the business cycle for a recovery. And what recovery are we talking about? Well, we're more recently talking about since the pandemic, what we've been through, what allowed us to recover so quickly from all the lockdowns and everything like that, and what also allowed us to recover so much, at least in the markets, and actually feel better about the economy at the very least in 2023 versus 2022. So I think that's worth some commentary. And for that, I'm going to bring up Moomoo, and later on in this video, I will tell you how you get up to 16 free stocks using my link that's down in the description. For now, let's pop Moomoo up there. And I got the SPY up here, which tracks the S&P 500. And here's the pandemic right here. And you can see the drop off that we had, and then this rally that we have. So a lot of people lost their jobs, and that interrupts the recovery loop that we have, because that also interrupts the amount of money that people can spend. That affects business sales, and things just go haywire from there. So then any sort of path that we're currently on, and we were on a nice path leading up to that, well, that loop got interrupted by the pandemic, by the lockdowns, by people losing their jobs. And then we were artificially sustained for a while through economic stimulus. And you can see that through 2021, at least, even though it's not necessarily the economy, we're sort of using it as a slight proxy for the economy. And so why did we peak out in late 2021 and then start to drop into 2022? Well, we had inflation fears. We also were losing economic stimulus. We also had Russia, and adding to those fears that we were going to have that wheat prices were going to go off the chain, and food prices were going to go through the roof, and oil prices were going to go through the roof. And that's why we see a lot of what we did there. And we also had the Fed really go aggressive starting in March on their quantitative tightening. So you can see the rip downward on that. Started feeling a little bit better about it. And then in August, we had the Fed come out again and said that they need to be really aggressive about things to really tame the inflation. And then we had another rip down all the way until October. And then in October, people started to think that we were sort of calming down on inflation, that the Fed was done with their tightening cycle. And so that at least allowed the market to anticipate a recovery from there. In January, you can see things really start to take off. So even though the economic stimulus was done, even though the quantitative tightening started and the federal funds rate had been increased, supply chains started easing, inflation pressures started to come down, the narrative started to shift, the market was able to rally, people were returning to work, and the job market was looking tight, and we just started painting a much rosier picture. And so you can see that happening in the markets. So let me bring up the business cycle thing again, because I'm not quite done with that. Pop it up there. So we have incomes rising, sales rise, production rises, employment rises, and it just keeps on spiraling around. And they refer to it here. This is on Investopedia. I got this graphic from a virtuous cycle. So what exactly is the interruption to the loop, if any, that is coming up? Well, something that I think about is interrupting this sales part, the part where sales rise. So this is a part with student loans coming, with consumer credit, with consumer debt. Those are the things that I think about that could possibly start to impact sales, which is going to impact production, which could cut employment, which could drop incomes, and then keep on spiraling around. Although in the opposite direction. As a matter of fact, if I scroll up, they actually have that one here. There we go, for the recession that we have going backwards for the vicious cycle instead of the virtuous cycle. So this is possibly what could happen. And it doesn't necessarily mean that we hit recession, but it is something that if we hit rampant growth and that we get to a peak in GDP, that it is possible that we start curling down the other way and we start declining into a trough. And at the bottom of that trough is typically where we find that recession before we start recovery and start heading back up again. So what I'm looking out for are signs of the interruption to this loop. Are student loans going to be that thing that really crush people economically to the part where they need to get more jobs to sustain their lifestyle? Is their current lifestyle sustainable? Are they able to keep on spending money out in the economy? Yes, they are making more money, but also things are more expensive. Are wages outpacing inflation? Will they continue to outpace inflation? So there's a lot to consider. It's nothing that's simple out there. I know that the word recession has been tossed around a bunch more recently. The difference is now, instead of it being January and the market's at the bottom, now it is August and the market is actually near the top. So that starts to make me think that this is a different talk about recession at this point in time. Like, things are getting pretty good. When do we start turning the other way? So that's something on the horizon. I don't know that it hits us now. As a matter of fact, that ties in with my video on CPI that I have that I'm going to prepare. I think that we have a few more months of good times ahead of us in the markets. So August, I think, should finish up pretty well for us. September could also possibly be pretty good. We're going to have to watch and see on that one. And then October could start to get a little bit troublesome. We're just going to have to watch and see where those different rotations are. We could see that rotation beginning at the end of September, that we start to see the hedge funds and institutions start to lock in profits, start to rotate to other areas. We want to watch for flights to safety. We can watch bond prices for that, and also bond yields, that if we start seeing that flight to safety, that instead of the higher risk plays, that could be an indication to us that they're starting to sniff out hard economic times ahead. Now, I did just want to share just one more thing, and this is probability of recession. This is from the New York Fed that was put out, and it was updated on August the 4th of 2023. And you can see, let me zoom in a little bit so you can actually see it better. There we go. If we look at 12 months ahead, right now, the probability of recession, according to the 10-year, 3-month spread that we have in the Treasury bonds, is currently sitting about 66%. So there still is when you keep on hearing the companies talk about economic uncertainty, nobody really knows when that's going to happen. And I'm not going to claim to know, but I am keeping my eyes open and looking for whatever evidence I can find that either we're going to continue to experience strength in the market, or it's one that we're going to start seeing some weakness. And if I start to find those things, then I can always make rotations in my portfolio to really hedge myself against any sort of downturn. I did that back in January. Didn't work out as well as I wanted, but still my long positions did very well over that time, and I was mostly bounced to the long side. Never feels good to lose money on hedges like that, but that's exactly what hedges are for, just in case things should go the other way. I said that later on in this video I'd tell you to get 16 free stocks using my link from Moomoo. Here's what you do. Click on my link down in the description for Moomoo, sign up, and if you make deposits of $100 or more, you get your free stocks valued up to $2,000 a piece. $100 gets you 5 free stocks. Every tier gets you a $50 cash reward, depending on which deposit level you choose. You still get that $50 cash reward no matter what. $5,000 deposit, $1,000 or $5,000 deposit gets you 15 free stocks. The $5,000 tier gets you that 1 free share of Tesla or EXPE. This offer does expire, so grab it while it lasts through the link down in the description. If you guys like my commentary and like to hear more of it, I'd like you to know that over at the Patreon, you can find that link also down in the description. You can click on that, sign up. Yeah, not only are you supporting my channel and help me keep the service going of what I have here and the value that I provide coming to YouTube, but also going over to Patreon as well, where my exclusive content resides, including, I'm going to put up my CPI projection that I have for that for July, which comes out on August the 10th. So be on the lookout for that. And I will share some of that information on YouTube, but if you want the full information, like I said, it'll be available over at Patreon. And you can also be a member of my private Discord community over there as well. So I know that this video isn't the happiest amount of information, but happy or sad, either way, we want to be prepared for what's down the road for us, being able to anticipate possibly what the market might do, especially for those of you who like to trade stocks, do the different swing trades and stuff like that. You maybe have your favorite plays, maybe currently have a lot that are well into the green by this point in time in the market, and you don't want to see that money go away. I'm in the same boat. I don't want to see any money that I've made over these past several months go away. So looking out to protect myself, coming out to YouTube to also share it with you. Thank you guys for watching this video. I am Dr. Stock, Doctor of Education. Remember, my friends, that learning is earning, and we'll see you in the next video.